All right, good evening, folks. Tim Davis coming to you guys with another market review. Today is July the 12th, 2022. The time is now just about 8 p.m. Eastern Standard Time. And as we continue to go through this bear market, and I see a lot of things unfolding, I will continue to bring these updates frequent and often, so that we can stay prepared and ahead of the curve when a lot of data is about to hit the fan. So tomorrow, Wednesday, CPI data comes out 8:30 in the morning. That could be market moving. And then right after CPI data, guess what starts happening? We have a slew of earnings that start coming out. The major ones will start coming out as of I want to say Thursday. We start getting the banks Thursday, Friday, and next week there's a slew of earnings that will be hitting the fan. So there's a lot of data, a lot of information that's about to start hitting the fan, hitting the economic cycle, and that will help guide market direction and give some more clarity. Are companies strong enough to survive in the current economic conditions? Will companies start to report or downgrade of their earnings? Will they start to revise a lot of earnings revisions to lower some of their expectations? We start seeing a lot of companies, lowering expectations because of what may have occurred over the past quarter or two. That's going to have to put more pressure on the markets, and that's what a lot of analysts are starting to expect, is that there's going to be a lot of earnings revisions, and the companies are going to start seeing the effects of inflation. They're going to start to be able to see the effects of inflation, such as what Target did last time when it revised its earnings. Instead, we're going to start to see more of that as we go through this earnings cycle. And just a brief look at what we can expect as far as earnings this week. The banks are going to be the first telltale signal as to how strong the consumer is. So this week we have on Thursday. It starts off in the morning with JP Morgan, which is a big heavy hitter. Morgan Stanley, a big heavy hitter. Taiwan Semiconductor is going to also be a telltale signal. So that's also something to keep an eye on Thursday. And there's a couple other unknowns and a few others. And then if you look at Friday, we have more banks coming in. Wells Fargo, Citigroup, BlackRock, United Health Group is another one. Pay close attention to. PNC, Bank of New York Mellon, U.S. Bank Corp, Progressive Corp, State Street Corp. Then once you get into next week, we really start to get rocking and rolling with earnings. Because by the time we get to midweek, by the time we get up to next Thursday, 124 companies report in the morning, 80 companies report in the evening. Next Friday, 70 in the morning, 31 in the evening. Next Wednesday, 17 in the morning, 30 in the, after the market close. So starting next Wednesday, we really start hitting the tape hot and heavy. And on Monday, you got more banks: Bank of America, Goldman Sachs, Charles Schwab, Synchrony Financial are a few of the ones that are reporting in the morning on Monday. Then Monday evening, we also have IBM, FB Financial Corp, and a couple others there. And then on the 19th, next Tuesday, in the morning, we have Johnson & Johnson, Halliburton, Lockheed Martin. They started to hit really heavy. Ally Financial, Hasbro, Signature Bank, Truist Financial, Citizens Financial, Manpower Group. And then after the market, we have Netflix, one to pay close attention to on next Tuesday. And then we have JP Hunt in the evening as well. Interactive Brokers. What else is interesting? Pinnacle Financial. So there's a lot of heavy hitters to pay close attention to between now and by the end of next week. And I'll just glance at one more, just in general, just showing you this to show you that after we get CPI data, and then I think we get more data on Friday morning, if I'm not mistaken. After we get CPI data, that's probably the most important one this week. Then we start seeing a lot of the earnings start to really start rocking and rolling. And they're going to be a telltale sign as to how strong our economic economy here here in the United States is, and how resilient is the consumer to continue to feed this economy. So next Wednesday we also have Tesla after in the evening. United Airlines, Alcoa, you get the picture. Earnings are going to be hot and heavy starting after we get the CPI data on Wednesday. Then start Thursday, we start to get the banks starting to roll in. So with that said, let's take a look at first thing we're going to look at this evening as we about to head into these earnings. I mean, head into the CPI data print tomorrow morning at 8:30, and then earnings right afterwards. For you guys who've been following me over the past 2 years, you know that I've been really harping on this. This is the percentage of S&P 500 companies trading above their 200-day moving average. The higher the number, the greater the the overall market health is. Back in April of 2021, look at that, we were as high as 97%. So back in April of 2021, we were as high as 97% of S&P 500 companies trading above their 200-day moving average. And as you can see, you know what I'm saying, if people have been living under a rock, you can look at this and tell that they haven't been paying attention to what's been going on over the past year. So we're definitely in a bear market and possibly heading into a recession. Anytime you go from almost 100% of S&P 500 companies trading above their 200-day moving average, then about a year or so later, we're down to just 18%, folks. You know, this market is slowly but surely just deteriorating month in and month out. And we're going to start to see these negative quarters pile up. And that's what's really going to start the economy starting to really, you know, get off their high horse and just go ahead and admit that, you know, we're in recession. So right now we're about at 18% of S&P 500 companies trading above their 200-day moving average. I think between now and next week, we could be down to zero. I think that's a very strong possibility. We could be down to zero. This is where my dash line is. I have this line on here for the past year, have not moved it. And we're getting very closer to that target of 0% of S&P 500 companies trading above that 200-day moving average. I think we're heading there. The last time we saw that zero number was back in where? Guess when? 2020, the COVID plunge. And if I was to draw this out, we was look at historic levels. This downturn that I see now, it looks to me to be more and more historical than any we have seen. I really think this is going to be an historical bear market that we're experiencing now. Not like we've probably seen in a long time. Back in 2008, 2007, 2008, we had a significant bear market, but there was a lot of nice bear market rallies, and that was pretty strong, as you can see. And here it's like this over this past year, they've been really muted. I mean, the bear market rallies we've seen, they have washed out real quick and fast. You know, as you can see here, these green candles represent a month. So these were some positive green months, but barely, they were barely positive green. Pretty much we've been in a straight downtrend, folks. And this doesn't seem like it's getting any better anytime soon. This could be an historic bear market we've probably never seen, never experienced in a lifetime. So I like to really stress how bad this looks. Look at the and I like to put moving averages attached to this tool so we can get a picture of how deep the direction is. Here is a 20-period moving average, which is this yellow line. As you can see, it started to roll over. Started rolling over way back in beginning of this year, and just starting to go down. When you start to see price action or the candlestick stay below that moving average, the 20-period moving average, that just shows you how strong the downward cycle is. That just shows you how strong the down cycle is. Stand by 1 second. 1 second, folks. Give me 1 second. One second, folks. Just had to send a message to my son real quick. Okay. And again, so looking at this, the percentage of S&P 500 companies trading above their 200 moving average, we're going to be at, we could possibly be at zero in no time, so folks. And then we have to see what happens once we get there. It's anybody's guess. Let me stretch this out to now a daily chart, and as you can see, that 20-period moving average has just been following price action downward. We in this channel that we were in with the dashed lines on top and the bottom, we even got to the point we've broken below that channel severely right here. Back at the beginning of June, broke below that channel, back up to the bottom of that channel, and now we're just trending right at that channel. I mean, right at that bottom trend line of that channel, and just below the 20-period moving average. And look at the oscillators already, and the full stochastics start to turn negative again already. And we barely got a chance to break above the 20-period moving average. So we could see this by tomorrow if the CPI data does not give enough, spark to this market. We can see this roll right over. You can see this roll right over real quick, real fast, and hit right back down. Test this area here and just continue to hit lower. So tomorrow, pay close attention to what happens after this CPI print comes out, because we could be in store for a shocker. Could be in store for a shocker. We could, and volatility is definitely with it. We could see a big spike in a market, then we could see a big drop. Anything's possible tomorrow, but I think by the end of this week or by the end of this next week, we could see this number down to very close to zero. That's the SPXA 200R. Now let's take a look at the VIX. I'll take a look at the VIX futures since that's what's running right now. Again, a couple things to point out. Looking at our VIX. Okay, the VIX is an oscillating oscillator, so it goes, it move off. It's price action movement pretty much. And as you can see, this has been our cycle over the past 4 or 5 months, past year. I mean, past 5 to 6 months. Back down to the bottom of the channel. Now, my speculation again, I say we are headed back up to the top of the channel, folks. That's just my observation by looking at the overall movement of the VIX over the past 6 months or so. Every time we have, sold off so much, we had a nice big spike back in the beginning part of June, and then prices just steadily sold off for several weeks, back down to the bottom of the channel, did not really break out below this trend line. So pretty much held there, waiting for some data or something that gives it a little juice to the upside. What could give it that juice to the upside? CPI data and earnings. So it has what it needs to travel back up to the top of that channel. What I'm gonna be looking for closely over between now and the end of this month is a breakout above this channel. If we get that breakout above this channel, folks, we're probably going to see something we have never seen in a long time as far as a steady move, a steady, stair-step move of the VIX up and above, up and away. That's something that we could see if we finally break above this upper trend line. So we got a lot to pay attention to as we go through the rest of this week and the rest of this month, as we start to get more and more economic data to come out and we start to go through this earnings season. And as you can see, other signals within the technical, from a technical aspect, we see the full stochastics is starting to turn up in the VIX. And we see we are out of oversold territory on the Williams percentage and away from oversold territory on our side. We're just hovering, waiting to see which direction we want to go. So tomorrow could be a telltale sign. Pay attention to the VIX again. If you see the VIX start to really ramp up, we're already back above 27. We see the VIX get above 30, folks. It's probably all bets are off. We're going to continue to march higher, get above that 30 level. And that's the VIX. Now, let's take a look at the weekly chart on the VIX too, because that's something interesting too. So this is a weekly chart on the VIX. This shows you the strength of this trend. Even on the weekly chart, we are right back at a level of support on the VIX on the weekly chart, and all it needs is a little push, and we can see a sustainable move higher in the VIX over the next several weeks. So that's something to keep in mind and worth pointing out. Now let's go to S&P E-minis, because the VIX is setting up for a rally. What could we be seeing in the VIX? A sustainable move lower, folks. We have been the same way you see whenever we get to a sustainable move higher in market action. See how we keep a sustainable level above the 20 per moving average. Once we establish a longer term uptrend on our daily chart and price action stays towards the upper area of the RSI. See how long we're able to sustain that overbought territory, dip a little bit, but back right up there, up in that overbought territory. We could possibly start to see that same action in the oversold territory in RSI, which means we would be in store for a sustainable move lower over a period of time. And we're already starting to see that price action is now maintaining a level below the 20 per moving average. And we could see that continue. Price action maintain a level below the 20 per moving average on the daily chart for quite some time, which means we can start to go into deep oversold territory, which would mean we would need to start paying attention to longer time frames, such as the weekly charts and the monthly charts, to see how long we could be in that oversold area. So that's a look at a weekly chart of S&P E-minis. Now, before I take a look at a monthly, we'll take a look at a daily real quick. Here's our daily chart, and you can already see the oscillator and the four stochastics starting to hinge lower. And we got the red line over top of the green line, which is a negative sign, pointing to more downward trend in action in the near future. And as you can see, price action is muted right at its 20 per moving average, waiting for direction. Either it wants to break above its 20 per moving average or it wants to break below it. My guess is that since we have been maintaining a level right at the 20 per moving average or lower over the past 7 months, like all the way back to January, I think we're going to continue that path. Nothing here that excites me to tell me we're going to break out in a major fashion and break this trend cycle just yet. We got a long way to go, folks. This bear market is just getting started. So that's the daily chart. If we take a look at a monthly chart, you'll see we're just starting to reach the lower band of just above the oversold level of the RSI. And again, the same way, this is a monthly chart. So the same way we can stay in overbought territory for a while, as we did back here from 2017 to 2018. And then again from 2021 all the way to where we are now. We can experience the same thing on the downtrend, folks. Nice sustainable move between 2013 all the way up to 2015 in the overbought territory on the monthly chart. Guess what, folks? The same thing we see with RSI as we sustain a move in overbought territory on the monthly charts for a longer term basis. We can see the same thing below the oversold territory. We could stay down here for a while. So that's something to consider and to think about, is that we could be in a sustainable move lower for a while. So we have to see how that pans out until economic news starts to get better. We can see these lower prices continue to stair step lower, such as that on a monthly chart. So that's something to think about and pay attention to as we go through this bear market and this economic cycle. All right. Switch back to a daily chart. Look at a Dow Jones, same scenario. They all look the same, folks. So I can uh, slap the Dow Jones right over top of the S&P, right over top of the Nasdaq, right over top of the Russell, and you'll see the same type of movement. So if you're seeing one, you're seeing the other. They all look the same, unless you know that they're all in lockstep together. And that's a strong signal, unless you know that the overall direction of the markets is definitely lower. Nasdaq is going to look the same. Just looks just like the others, and ours and Russell won't look the same. Russell just a little bit weaker. I see it all look the same. Now, another telltale sign that markets probably are about to head into about to face some serious problems to the downside. If you look at this weekly chart of the Russell, you can see that we are right back at the highs of 2020. And look what happened after we reached those highs of 2020. We eventually broke and could not break above that level of resistance and headed lower. So we're back at that level of resistance. Former resistance becomes support, and looks like the support is about to be broken. Where could we be headed to? If we break this current long-term support, we could be headed right back down to the COVID lows, folks. That's what I think we're really headed eventually. I think we're headed back down to those COVID lows eventually. And what else is telling us that these overall markets are about to probably experience a lot of heavy pressure to the downside? Look at copper, folks. Copper, they call it Dr. Copper for a reason, because copper is normally the precursor of what we can expect to see in our markets. Look at what happened with copper. Copper was on a tear earlier this year. It got it to as much as $5. $5 on copper's futures. Look where we at now, back down to 3. And look at the pressure to the downside, folks, on copper. And it's been heating up lately. Really been accelerating to the downside. So normally, Dr. Copper, if you probably heard it before, is a precursor of what we could expect to see. It leads the market. So look what happened 2020 when Dr. Copper failed at this level of support. At resistance. It just fell off, went down pretty quick. Look what copper did now. So I like to point out to say that the markets are probably going to do the same thing copper is doing, folks. Really start ranching to the downside. So that's something to keep in mind until we see a recovery. Once we start to see a recovery in copper, the markets will probably be behind it shortly. But until then, we got to go through some pain, some more pain in the markets. All right. So again, these commodities are really starting to see some pain. Look at crude oil. Crude oil starting to see some pain. Here's a channel that I was able to spot in crude oil. We tried to get back up to 129, but couldn't quite make it. And then we just started to pull back, starting to run into some areas of support. But I think those support levels may be broken. It's a huge possibility those support levels could be broken, folks. Here is crude. And it's like it's about to test some areas of support. But if these levels don't hold, folks, we could see crude drop below 90 and head back towards 70, folks. So that's something to pay close attention to. All right, folks, that is, I think I gave you guys a lot to digest between now and the rest of this week. And as we go through, you know, major changes throughout this week, I'll probably come back to before we even get to Friday with another update. So again, looking at Dow Jones E-minis right now, it's like we are in a holding pattern. It's a daily chart. We are in this holding pattern, folks. Back up to the 20 per moving average, but we are in a holding pattern. Here we are, back to the 20 per moving average, and we are just, you know, just mannering around here, waiting to decide, you know, where the next big move is going to happen. We're going to wash out and break this support level, or we're going to rally higher and off to a new bull market. I beg to differ if that happens. All right, folks. Hopefully this is something you guys can use. Be nimble, be careful, and remember, you know, for your long-term buy and hold investors, you need to be careful during this time frame, because what if it takes 13 years for you to, you know, if you jump in now and it takes 13 years for you to get to see a return. You know, if you're new to investing and you're just starting to put money in the market, you may have, you know, 13, 15, 20 years to sit back and relax and enjoy your profits later. But for those folks who, you know, looking to see some significant gains now, learn to trade the other side of this market. Learn how to trade the downside of this market, and then use those profits when the market finally, you know, gives us, you know, a bullish tone, longer term sustainable bullish tone. You'll be ready to have some profits that you made on the downside to reinvest and be ready for the next mega move up, which also could be an historic move. All right, catch you guys on the next video.